All right, let's get right into it. There's this massive, and I mean massive, contradiction happening in our economy right now. On the surface, things look absolutely incredible for some, but you just have to scratch a little deeper, and, well, the story gets a whole lot more complicated.
So, on one hand, you've got the tech market, which is just completely on fire. The NASDAQ index, that's the one that tracks all the big tech companies, it's at an all time high, up a whopping 32%. And what's driving this? You guessed it, an explosive boom in artificial intelligence. But, and this is a big but, at the exact same time, the real world economy, the one that actually makes and ships stuff, it's slowing down. Projections show global growth is actually set to shrink year after year. So what gives? How can tech be soaring to the moon while the rest of the world seems to be hitting the brakes? And if that wasn't confusing enough, there's this. We're seeing these huge, headline-grabbing layoffs. And these aren't just small companies. We're talking about giants like UPS, Amazon, Intel. It's creating this deep sense of instability for millions and just adds another really confusing layer to this whole AI paradox. It all boils down to this one really important question. Is this AI boom the real deal? A genuine, fundamental shift in how our world works? Or is it just a classic investment bubble, pumped full of hype and about to spectacularly burst? Let's break it all down. First up, let's look at the warning signs. Let's make the case for this being a classic bubble because, history has a tendency to repeat itself, and it has a lot to teach us about how these things can end. And it's usually not pretty. And we have been here so many times before. From Japan's bubble that led to a lost decade of stagnation to the dot-com crash that took a full 15 years for the market to recover. These aren't just little blips. A burst bubble can be devastating, with consequences that can last for a generation. We're talking 15, even over 30 years, just to get back to where you started. The stakes are incredibly high.
So how do you even spot a bubble before it pops? Well, one of the most famous tools is called the Buffett indicator. And it's a really simple but powerful idea. It just compares the total value of the entire stock market to the size of the actual economy, the GDP. Think of it as a reality check. It asks a simple question. Has the hype completely outrun the real world?
And right now, that reality check is flashing bright, bright red. The indicator is at 217%. Let me say that again. That means the stock market is currently valued at more than double the entire US economy. And here's the really chilling part. That level is almost identical to where it was at the absolute peak of the dot-com bubble right before it all came crashing down. And it's not the only gauge screaming awarding. There's another one, the Shiller P/E ratio, which is a fancy way of checking if stock prices make any sense compared to a company's actual profits over time. And yeah, it's also deep in the danger zone. But maybe the most powerful signal isn't some complex formula. Maybe it's just a simple question. What are the insiders, the CEOs, the top execs, the senior people inside these tech companies? What are they doing with their own money? And the data here is, it's staggering. Right now, for every one insider buying their own company's stock, there are over 4,000 of them selling. That is just an astronomical ratio. It strongly suggests that the people who know these companies best think that prices are at or very, very close to the absolute peak. Okay, so the case for a bubble seems pretty strong, right? It kind of feels like we should all be running for the hills. But hold on, let's flip the coin here. What if this time is actually different? Let's explore the argument that this AI boom is the real deal. First off, let's talk valuations. Yes, they're high, no doubt about it. But they are nowhere near as disconnected from reality as they were back in 2000. Back then, the NASDAQ was trading at 60 times its earnings. 60! Today, it's at 30. Still expensive, for sure, but that's only half the level of pure insanity we saw during the dot-com frenzy. And this right here might be the most crucial difference of all. Unlike the dot-com era, today's AI giants are actually making money. Remember companies like Pets.com? They were just burning through cash with no real plan. Today, a company like OpenAI is already pulling in billions of dollars in revenue from real products that people are actually paying for and using. Now, that doesn't mean everything's perfect. Of course not. There is a huge, huge gap between the money being poured into AI and the revenue it's actually spitting out right now. But you could also see this as a huge long-term bet that AI's growth is really just getting started and that it's about to become exponential. I mean, think about it. We're still in the very first inning of this game. Less than 10% of companies have really started using this stuff. The potential for growth as the other 90% of the economy gets plugged in is, well, it's enormous. But to really get what's going on, we have to zoom out. Because if we only focus on AI and stock prices, we're missing two other gigantic forces that are reshaping our entire global economy as we speak. First, let's go back to those layoffs. It's really easy to point the finger at AI, but the real story starts right here with this chart. During the pandemic, when interest rates were basically zero, companies went on this absolutely unprecedented, historic hiring spree. The number of jobs just exploded to levels we'd never seen before.
So here's the key takeaway. These layoffs aren't really a sign of a new crisis. They're a natural, although painful, correction. It's the economy trying to rebalance itself after that completely unsustainable peak. It's not so much that AI is taking jobs yet, it's more that companies are just getting back to normal after a very abnormal period of growth.
And the second massive force? Geopolitics. We are smack in the middle of an escalating economic war between the US and China. We're seeing new tariffs, a strategic disconnection that's disrupting supply chains we've relied on for decades, and it's creating widespread instability that has absolutely nothing to do with AI.
So, we've seen the case for a bubble, we've seen the case for a brand new reality, and we've seen all the other chaos going on in the background. Where does that leave us? Let's try to put all the pieces together and reach a verdict. Well, the answer isn't a simple yes or no. Is there an investment bubble? Yeah, most likely. I mean, you can't look at those valuations and say things are normal. But is it going to crash and burn like the dot-com bubble? That seems unlikely. The foundation of real revenue and real technology is just so much stronger this time. Instead, we're probably looking at something else, a fundamental reorganization of power in the tech world. So, forget about a total market collapse. What we're much more likely to see is a consolidation. A handful of truly colossal companies will win and basically control the future of AI, while thousands of these smaller, hyped-up startups, they're just going to fade away. We're about to witness one of the biggest shifts in technological monopolies in modern history. So in the end, asking, is it a bubble, might just be the wrong question. This isn't just about timing the market. The real takeaway is understanding this huge power shift that's happening right under our noses. The much more important question we should all be asking is, who is going to build, own, and ultimately control the future?